Hello, everybody. We are waiting for people to join before starting. And in another few seconds, we'll start. Okay. So welcome everybody to this webinar on the loan guarantees, bank guarantees, public guarantees on bank loan to firms and as an instrument of public policy. This webinar is organized by two research and policy networks of the CEPR. One is the European Economic Policy. The other one is the European Financial Architecture, and the EMU lab here at the European University Institute. The seminar is organized and moderated by me, Giancarlo Corsetti, Laura Bottazzi, that you see on the screen, and Jan-Pieter Krahnen, that also you see on the screen. We will collaborate in a sort of helping framing the discussion. So what is the seminar about, the webinar about, is that one of the successful measures taken, or set of measures taken during COVID, we will see that at least so far, given the experience in COVID and the post-pandemic time, a balanced assessment of the public guarantees on bank loans is so far positive, and it's about time to have a first reflection on the conditions and the design that makes this measure successful. I can make this measure successful. You know, if in case in the future we will think about using them more extensively as we did during COVID. So this is a crowded seminar. We have a very good group of people talking about this. We will start with Marco Pagano, who is a member also of the European Financial Architecture RPN, who will focus on the experience of Europe. And we will widen our scope, broaden the discussion with the intervention by Linda Goldberg that you see on the screen, and Stefano Ungaro that you also see on the screen, and Giancarlo, and other authors that cannot be here for many reasons, including the time difference, but they will tell us, they will give us a broader perspective on these measures, including the US experience. So I think I said everything. Laura or Jan-Pieter, if you want to say something, you need to unmute yourself, Jan-Pieter. You need to unmute yourself.
Yeah. Oh, sorry, Giancarlo. Can I just add one thing?
Please.
If any questions that people may have, they should please write it in the Q&A. There's a button on the bottom of your screen, and then we can read it out and use it as input in the discussion. Thank you.
So let me say only one last word. So we would like to have the question at the end, possibly. Okay, but if you really need to ask something, we can even you can even intervene in chat, of course, or a Q&A. But we would like to have the discussion at the end. Thanks so much.
Fantastic. So I guess we can start. Marco Pagano, can you share your
okay
slides?
Okay, can you see my screen? Hello?
Yes.
Yeah.
Perfectly.
Okay, well, first of all, thank you very much, Giancarlo, Laura, and Jan-Pieter for inviting me to present this first piece. I'm going to talk about loan guarantees and public policy with reference to the Euro area, drawing on evidence from mainly work that I have done recently on this with some co-authors of mine. Let me start from brief overview of why we have loan guarantees. I mean, the objective of loan guarantees is quite obvious, is to encourage lending by shifting default risk to the government without fully compensating the government for the cost. And compared to direct lending by the public sector to firms, this has an important benefit, which is leveraging banks' screening expertise and administration network, but also comes with some possible issues. One is that you must obviously compensate banks for the cost and risk of their participation. You may end up overcompensating them, that is, leaving rents on the table. The other one is that you must incentivize banks to do actually extend additional lending, that is, avoid simply substituting their pre-existing lending with guaranteed loans. And thirdly, you must incentivize banks to avoid excessive risk-taking. So you have to avoid moral hazard reasons, since banks are aware that they're playing with money which is eventually going to be guaranteed by the government. Compared to traditional fiscal measures such as fiscal transfers, both loan guarantees and direct public lending have the obvious advantage of being more cost-effective because some of the money comes back. Hong and Lucas, in their Brookings Papers article in 2023, they estimate an average subsidy rate of 37% for European and US loan guarantee programs on average, to be compared with 100% subsidy rate for traditional fiscal measures, transfers, where no money comes back. And in terms of cons, they are the same as above. I mean, if you compare loan guarantees with direct public lending, again, you have those three problems that I was mentioning before. Now, how do you limit the cons? How do you limit these issues? Well, here, both allocation and design are key. Allocation in the sense of eligibility rules, which borrowers are allowed to get loan guarantees. And here the issue is obviously a possible adverse selection. Banks would have the incentive to de-risk their worst clients, and their worst clients would be also those that would benefit the most from lower interest rates and more lending. In terms of design, you can design the program in several dimensions. You can choose the amount of the loan that you're going to cover, the maximum interest rate and maturity that the bank can afford, whether banks have to be charged guarantee fees, whether loan sizes should be limited or not. And here, the way you want to design these conditions is to limit the potential substitution with pre-existing exposure. So what I was mentioning before, that the fact that banks with exposure to a firm could ask the firm to use the guaranteed debt to repay existing loans. Why do banks have the incentive to do so? Well, first of all, because in general, guarantees are partial. They offer partial coverage. And therefore, a guaranteed loan typically requires the bank to anyway take an additional exposure to have more skin in the game than before, which banks may be unwilling to take. So that's one reason why they may want to reduce their existing exposure. Another reason is that insofar as a guaranteed loan does not require the bank to have more skin in the game, it reduces bank monitoring, or at least it risks reducing bank monitoring, creating moral hazard. That is, anticipating less monitoring and therefore more credit risk, banks that were previously lending to the firm may decrease the non-guaranteed loans to the client with the guarantees. And even if there is substitution, firms may still be willing to take, be happy to take a guaranteed loan if they can get a lower interest rate on that loan. So how to limit these issues? Well, how these issues have been limited to some extent in the context of European loan guarantee programs. The guidelines provided by the European Commission at the moment in which these programs were started in 2020 where, first of all, eligibility rules. The European Commission recommended that these guarantees should be preferentially be allocated to small and medium enterprises that face difficulties as a result of the pandemic. So these two requirements, size, small size, relatively small size, and having problems as a result of the pandemic, but problems should not be too big in a way, because it excluded undertakings in difficulty. That is, it recommended excluding from the program firms that were effectively already not viable, because more than half of their capital had been wiped out by losses, or because they were already involved in insolvency proceedings or fulfilling the criteria to do so, or they had received rescue or restructuring aid and had not yet reimbursed it, or they were very heavily indebted and had low coverage ratio in the previous 2 years. So in terms of design, the conditions in which guaranteed loans should be offered, should have been offered according to these guidelines, were, first of all, the coverage should not be complete, should not be 100%, it was recommended. And in fact, most programs in Europe had guarantees coverage between 70 and 90%. Only few programs had 100%, such as Germany, KfW Instant Loan Program, and Italy's Fondo di Garanzia for small and medium enterprise loans below 30,000 euro. Moreover, it was recommended that a ceiling should be placed on interest rates and maturity restriction, a more stringent one for SMEs, and that interest premia should be increasing in maturity, with maturity anyway not exceeding 6 years. Then it was recommended that banks be charged fees, 25 to 200 basis points, also increasing with maturity and firm size. And finally, and probably most importantly, it was recommended that the loan size should be fixed and should be made proportional either to the annual wage bill of the beneficiary in 2019 or to the beneficiary's total turnover in the same year. So how did all these features play out in practice? And here to attempt an evaluation of the program, both in terms of eligibility, allocation of guarantees, and in terms of the extent of the substitution, there was actually undertaken by banks for guarantee recipients. I will draw on previous work that I have with Carlo Altavilla, Andrew Lull, Andrea Polo, and Thomas Vlasopoulos at the ECB. We use bank firm level euro area data drawn from the AnaCredit database, matched with the ECB supervisory bank level data. We focus on the 4 largest companies in the euro area: France, Germany, Spain, and Italy. In the database, we only have loans above 25,000 euro. The loans, smaller loans are simply not present in AnaCredit. Still, we have data for 2.5 million firms, 20% of which received guaranteed loans between March and August 2020, which is the period on which we focus in the analysis. Then, first of all, in terms of allocation of guarantees, what do the data say? First, we find that the largest amount of funding in terms of loan guarantee programs was made available in Spain and Italy. As you can see from this graph, the smallest program was the German one. Most of the funds in all 4 countries were allocated to SMEs. The blue portion of these bars refer to small firms, less than 50 employees, and the yellow ones to medium firms. Another feature that we find in the data is that even though Germany, the German program was the smallest in terms of total size, it featured the largest loans. So the average size, which is the little yellow bar that you can see here, was actually larger in Germany than in the other 3 countries. Spain and France are in between. Italy had most small loans. Now, in terms of which firms received the guaranteed loans, here just looking at descriptive statistics for the full sample and for the subsample of firms receiving guaranteed loans, you see, first of all, that, as I mentioned, 20% of the firms received guarantees. This is a dummy variable, takes value 1 only for firms with guarantees. We see also that the average coverage of the guarantees was 57%. But more interestingly, we see that indeed more guarantees were given to smaller firms. The log size, the log firm size in the subsample for firms receiving guaranteed loans is actually smaller than, in fact, significantly so than in the whole sample. We also see that more guarantees were given to firms in more affected sectors and countries. If we look at the industry value-added growth in the sectors of the firms concerned, we see that this number is considerably smaller in more negative, so to speak, in the subsample of firms receiving a guarantee. So these firms were in countries and sectors where the value-added growth actually was lower, that is, were worse hit by the COVID pandemic. And finally, and probably most interestingly, more guarantees were given to less risky firms, ex ante, where this is measured by arrears in December 2019. So we see that actually the riskiness of the firms with this indicator is considerably smaller in the subsample of firms with the guaranteed loans. And also interestingly, more guaranteed loans were extended by larger banks. We see that the size of the bank, the log size of the banks providing the guarantees is actually larger in the subsample of firms receiving guaranteed loans. On the whole, guaranteed loans were not adversely selected. They were skewed towards affected SMEs, but not towards riskier firms. And actually, there is a recent paper, which is not online yet, but will soon be, by Bonaccorsi Di Patti and co-authors at the Banca d'Italia, that confirms the evidence that the firms receiving loan guarantees were less risky than the others, using another measure of risk, not arrears as we do, but the bank's regulatory probability of default to measure credit risk. Now, what in terms of substitution of guaranteed loans? To what extent actually banks that were given the possibility of being assisted, lending with such guarantees, actually simply replaced, to some extent at least, their pre-existing loans. And here, measure of this substitution is the change in the non-guaranteed credit relative to the period before the pandemic divided by total initial credit. If this amount is negative, it means that the bank that was actually issuing the guaranteed loan was cutting back on pre-existing non-guaranteed loans. And we see that this was actually negative in all 4 countries for most loans. In particular, for Italy and Spain, we see that almost the whole distribution of this Y, this variable, is below 0, meaning that there was substitution for almost all lending by banks that were assisted by a guarantee. In France and Germany, it was the case for about 3/4 of the loans. Clearly, if this number is negative, it means that there is substitution. So we're going to measure substitution with the negative of this Y, minus Y for a given firm or a given bank-firm relationship. We also see here that if we look at the subset of banks that were lending guaranteed loans to a firm that also was borrowing from other banks. So we look at the subset of firms that were borrowing from multiple banks, one of which only was protected by a guarantee. We see that the bank that actually was providing the guarantee is the one that engaged the most in substitution, which is this blue bar, whereas the red the yellow bar measures the change in the lending in non-guaranteed loans by the banks that were not covered by a guarantee. And in fact, looking at the whole sample, we find that on average, the banks that were assisted by guarantees reduced their non-guaranteed lending by 36%, while the other banks that were not assisted by the guarantee only did so by 4%. And the phenomenon is particularly evident and large in Spain and Italy. And this is particularly interesting because it compares substitution by banks lending to the same firm. That is, it holds firm's characteristic constant. And the question is whether it holds or not in a panel regression with firm and bank fixed effects. And the quick answer is that it does. If you run a regression in which the dependent variable is substitution as defined before, on whether, and here we are using data for bank-firm relationships and we have a dummy which takes value 1 for the relationships that were assisted by guaranteed loans. You see here the banks providing guaranteed loans were substituting between 30% and 32% more than other banks lending to the same firm. So here we're only using data for firms that were borrowing from multiple banks, one of which was assisted by a guarantee. So here there is considerably more substitution, as we can see here. And this substitution is actually larger for weaker firms. So those in more affected sectors and countries, smaller, with smaller size and riskier. So the results for the interactions between the guarantee dummy and industry value-added growth, size, and risk tell us that weaker firms experienced more substitution. Actually, substitution was greater for stronger banks, those that had fewer non-performing loans. And this is confirmed also by firm-level regression. So instead of using just data for bank firm-level regressions, we use data at the firm level. We find again that substitution tends to be larger when the guarantee is larger, the elasticity being 13%. So essentially, €1 of a guaranteed loan was associated with 13 cents less of non-guaranteed credit. And again, this was actually greater, this elasticity was greater for weaker firms, that is more affected, smaller and riskier firms. So it was more of a problem. Essentially, banks cut more on non-guaranteed lending for such firms. And actually, the stronger and larger banks engaged more in such substitution. Let me say just a word regarding interest rates and maturities. Bank firm level regressions for interest rates and maturity show that firms with long guarantees faced a reduction in interest rates by the bank issuing the guaranteed loan. So essentially, firms benefited in terms of lower cost of borrowing. And in fact, the more fragile firms got larger interest rate cuts, and stronger banks offered a relatively smaller interest rate cut. And the same actually applies for changes in maturity. So in a way, it looks as if there was some kind of a deal by which more fragile firms were indeed faced with more substitution, that is less of an increase in lending, despite the fact that it could offer a guarantee, but they at least had a greater improvement in interest rates and maturity. Now, let me just say a word regarding post-COVID bankruptcy rates. We do not have data in our study regarding what happened to those loans after COVID, but actually there is a recent study by Corsetti, Patti, and co-authors that I already mentioned that provides such data, such evidence. And they find that guarantees correlate with lower post-COVID bankruptcy rates. In fact, firms that received guaranteed loans had a 4% less probability of default after COVID. They also show that guarantees were allocated to firms with a smaller ex-ante likelihood of default. They have a clever test showing that. Let me just conclude with one word regarding concomitant policies. Loan guarantee policies were not taking place in a void. They were actually enacted together with other policies, in particular short-term work programs and outright grant programs. They were providing an increase in firms' equity financing at the same time as the loan guarantee programs were enabling firms to borrow more. Now, this could have been an important feature that explains to some extent the success, if you wish, of the pandemic loan guarantee programs, because these firms were enabled to avoid excess indebtedness because someone was providing to them an increase in equity at the same time as they were increasing their indebtedness. There is little research on this, but there is a very nice paper on Chilean data, on Chile, by Huneus and others, that actually shows that the short-term work program in Chile mitigated the indebtedness expansion due to the credit program because it supported firms and it enabled banks to better screen their risk. So in conclusion, it looks as if from the evidence in the euro area, there was a rather good selection of guarantee recipients. Guaranteed loans were mainly directed to small firms in affected sectors, but not those with the highest pre-crisis risk level. However, it is also there is a negative correlation between guarantees and post-COVID bankruptcies, as I mentioned. However, it is true that banks that received guarantees engaged in sizable substitution, especially for riskier firms. And one may wonder how to look at that from the policy viewpoint, whether, you know, the fact that banks were able to engage in such substitution had any policy upside. One can probably guess here that it enabled a certain amount of bank recapitalization, some kind of backdoor recapitalization of banks, insofar as banks were overcompensated for their additional credit risk, then they were in a better shape to provide credit post-COVID. And another plus is that there may have been less debt overhang post-COVID as a result of this substitution, because more fragile firms, as we saw, were prevented from taking excessive debt owing to the guarantees.
Thank you, Marco. We are running a little bit short of time, but a lot of material. While Linda would upload the slides, I just want to say, please ask questions using the question and answer. Everything we say, there are 2 links to the papers. Underline the presentations with links at the end of the page of the webinar. And also welcome Sonali Casina that just joined, another of the authors of the large CEPR Policy Insight that now Linda is going to introduce. Please, Linda.
Okay, thank you for having us. Can you see my screen?
Yeah.
Okay, so I'm going to introduce work that we put out as a CEPR policy brief, and I'm also going to talk about the evidence, the structure of programs in the US. So first, usual disclaimer, these are my views and not those of the Federal Reserve and Federal Reserve System. The work that Stefano will talk about is actually done by the International Banking Research Network. So I'll say a couple of words about what that is and how the IBRN collectively considers policy relevant questions. We at the IBRN posed a bunch of questions about programs of government support of bank lending during the pandemic experience. And basically, you know, we heard from Marco about the European experience, and we heard a bit about the heterogeneity in programs across 4 countries in the EU. The IBRN, as I'll introduce, has a very broad membership. around the world, these programs were widely applied, and they had very, very different parameters. So we really kind of posed the question, and we continue to pose the question about whether we've collectively learned enough from this global experience. So I'm just setting that up. I'll say a couple words about one of the programs in the US, the Main Street Lending Program. And again, very happy that all of our study authors are on for this webinar, but there were others across the network who gave content. So who are in the IBRN, the International Banking Research Network? We're a network of researchers, financial stability people from central banks and international organizations with over 30 participating institutions from all over the world. What we do in the IBRN is the membership collectively determines what is a policy relevant issue. So we have surveys of the membership, we discuss this, we vote, we define an initiative, we ask about, what would we need to do to inform this initiative? Is there a feasible experiment design that could be done? We set up a methodology team to look at the analytics for this kind of work. And then countries go and use their own granular data, the kind of information Marco discussed, to look at the issue. And then we just work together. We don't share confidential data, but we kind of move forward these initiatives so we get policy relevant answers. Now, in the case of this particular initiative on understanding government guarantees of bank lending programs, it was interesting. The IBRN membership agreed on interest in the topic, but ultimately in a lot of kind of policy institutions, the hot topics moved on after the pandemic. And we still felt that it was important to emphasize that there was so much more to learn from this particular topic. So a small team put together how to approach this. We put together a research survey and also a survey of our membership with questions so that we could find out what they knew about the effects of their programs and also see the heterogeneity across these programs. And in fact, we observed substantial heterogeneity across countries in the types of terms of implementation that Marco laid out for the EU, that span to the terms of government guarantees and the types of banks and firms, as well as the costs of these programs and all the kind of participation criteria. We also found that across countries and across most of the research community, when they talked about these programs, the measure of success was often continuity of credit provision. So you don't want an amplification of the adverse effects of the pandemic, which is great. But there are still opportunities for drawing broader lessons. What about the composition of credit? What were the longer horizon consequences for firm incentives, for zombies, for productivity, the type of selection that took place? Also, what was the range of fiscal costs? Because as you came out of the pandemic, where there was a lot of fiscal needs and targeted programs, of course, for a lot of countries, this also meant squeezing their post-pandemic fiscal space and their ability to respond if something else came up in the near term or even the medium term. So we asked these questions about fine-tuning the parameters. Stefano will talk more about that. Just a couple of words about the US. The Federal Reserve in the US had many facilities that were established in the spring of 2020 designed to support the credit needs of households and businesses. Several of these had been previously established and useful in the global financial crisis, but there were many more. We had a paycheck protection program basically targeted at supporting wages. the Main Street lending program that I'll talk a little bit about. We had corporate credit facilities, commercial paper funding facilities, primary dealer funding facilities, money market mutual fund, term asset-backed securities, municipal liquidity facilities. So lots of stressed market segments, lots of different programs. The Main Street lending program is the closest to the topic we're talking about today. It targeted small and medium-sized businesses and nonprofit organizations. By the way, small and medium-sized businesses, even nonprofits, have very different definitions across countries. So what's small for one country might be very large and outside of scope for another. In the US, the loans originated under the program had these same kind of features that Marco discussed to help borrowers facing challenges. In our case, it was 5-year loans with floating rates, principal and interest payments deferred. The Federal Reserve bought 95% participation in loans from lenders, and pro rata shared the credit risk with the lenders. And because the Federal Reserve cannot take on credit risk, it can take on liquidity risk, but not credit risk, the US Treasury served as a backstop for these facilities, and funds were appropriated through the Treasury through a federal act. And this program ceased purchasing participations in January of 2021. So very, very briefly, the borrowers engage directly with the lenders, and they apply for the loan. The lenders fund the loan. The lenders then submit loan participation information to a special purpose vehicle that's was set up for this Main Street lending facility. The special purpose vehicle bought 95%. The lender retained 5% of this. And again, you have this kind of treasury backstop of this facility. There were actually 5 different types of Main Street lending programs that took place, with different types of borrowers that each of them covered. So for example, for for-profit organizations, this covered a wide range of loan facilities, loan sizes, and 3 different types of facilities. And they had their own restrictions on business size, and they had different fees applied. And there were, kind of principal payments and interest payments terms set out here. There's actually a very somewhat different set of loan guarantees and requirements for nonprofits, which came on a little bit later. So in terms of current state, just to be brief, because 2 more slides, actually this, 1 more slide, this one. Current state on the US Main Street lending facility, I said it stopped those new originations in 2021. It ultimately supported more than 2,400 borrowers with loans totaling $17.5 billion. As of right now, or August, when it was last publicly reported, the total amount of outstanding loans in this special purpose vehicle was under $5 billion. There was still over $10 billion of collateral pledged on this. And this special purpose vehicle recognized approximately $1 billion in actual credit loss, net of subsequent recoveries. There have been studies of the US programs, but I just want to flag one in particular, tying into Marco's results. In what he presented, in the case of the US, the borrowers at the Main Street lending program were on average riskier than those at comparable large banks. The program was found to reach industries and geographies that were most affected by the economic effects of the pandemic. However, and you could look at this borrower number up here for context, there also have been some conclusions that have been made that the program's structure and complexity limited its attractiveness to both lenders and borrowers. And the kind of analytics on that pointed to the risk screening process, the high origination and servicing costs, reporting requirements on firms, and needs to invest in new processes that delayed underwriting. So I think that's important to keep in mind for the kinds of things that Marco just discussed previously and that Stefano will discuss now. So with that, I will stop sharing.
Fantastic. Thank you, Linda. Laura, you take it. Stefano?
Yeah, here I am. So I'm sharing my screen now. Can you hear me?
Yeah.
Okay, so so good afternoon, everyone. It is a pleasure to be here today with all of you. I thank Laura, Giancarlo, and Jan-Pieter for organizing, and of course Marco and Linda for the excellent presentations. And actually, both presentations allow me to take for granted a lot of elements that I was going to talk about. So what I'm presenting today is the result of a collective work done in the context of the IBRN that Linda just presented. And I would first like to greet and thank the co-authors, not only Linda, but also Jen and Sonanika, who are here, because this was a nice team effort. And it is always nice when a collective effort results in what you can call a more than the sum of the parts. So, of course, since we all work or worked in central banks or policy institutions, the usual disclaimer applies. So from the beginning, the sense of our work was that of identifying key issues that could come from government guarantees on bank loans and draw lessons for future policymakers. So the idea here was to be prepared in the hopefully as remote as possible eventuality of new measures to be taken urgently and therefore without time to think, and thus have a ready-made toolkit in a way. So in reality, however, these lessons can be applied also to other contexts as well. So one, for instance, is to use, if you decide to use loan guarantees within the policy mix to support private investment towards the competitiveness transition, as I like to call the purpose of the Draghi report. So our work here was based on two parts. Okay, so on one side, a survey of the literature on government guarantees to lending, with a specific focus, obviously, on the programs that were implemented during the COVID crisis, and a survey that we circulated in summer 2023 among 17 central banks that participated in the IBRN. In the survey, we asked central banks about individual country programs, the banks that had made the loans, the firms that had received them, and the lessons learned. So let us begin with the survey. So first, some background information. Most of the programs were aimed at supporting small and medium-sized firms, enterprises, as they were considered as most vulnerable to liquidity risk during the COVID-19 crisis. And an important element that united half of the surveyed countries was that governments imposed low interest rates in an environment that you will remember had at the time very low interest rates. And this was done to reduce the risk that banks could make profits without taking risk themselves, what is called the windfall effect. The survey reveals that these programs were quite large in size. Okay, so their median scale corresponds to 1% of GDP of the countries that responded to the survey. And two particular cases are those of Italy and France, which were, however, the first countries to be affected by the pandemic, both chronologically and in terms of the number of fatalities. So that explains it in part. Our study has a focus, has two focuses. We couldn't cover everything, so we had two focuses, one on risk taken by banks and moral hazard, and the other on effectiveness of the programs. So let us start with the risk taking part. And from the survey, and this I think is one of the most important things that we did, that from the survey that we distributed among IBRN members, we isolated 4 common features in program design. Each was applied in part, if not all of the countries, and these features generally constrained excessive risk taking by banks. And this is a first response to something that I already read in the chat, and this was a question from Marco. So these features concern limits on the amounts that can be borrowed by firms, restrictions on the destinations of the borrowed funds, restrictions on borrowing firms, and the partial government coverage of the loan themselves. So let us look at them in detail. First of all, in all countries that responded to the survey, limits were imposed on the amounts that could be borrowed. Okay, so these were either computed according to the economic activity of the firms pre-crisis, okay, usually December 2019, and these could be sales, revenue, payroll expenses, turnover, or in another half of the country by applying a fixed limit for all firms or some categories of firms, depending, for instance, on their size. And this was intended to ensure that small amounts were borrowed to overcome temporary liquidity problems. But at the same time, they wanted to policymakers wanted to make sure that firms did not get too much into debt, with obvious possible consequences, negative consequences for them at first, for their banks, and eventually for financial stability if this would have become too large. On the second point, 14 out of 17 countries that responded to our survey, so most of them, applied restrictions on the use of borrowed funds by firms. And in most cases, loans were to be used to finance working capital or operating costs. So once again, short-term things, okay? Just to overcome the period of uncertainty and crisis. But one particularly insightful design feature was introduced in the programs of 3 countries that we can name because the countries allowed us to name them, which were Sweden, Finland, and the US. And that is to explicitly and from the outset prevent the use of public guaranteed loans to repay existing debt. And this has happened in other countries where this feature was not included, as Marco showed us just now, and that we know very well in France, in Italy, in Spain, in Germany, in the euro area in particular. And this is for the second common feature that we find. Third, more than half of the countries that participated in the survey applied restrictions on the type, riskiness, and size or size of the firms that could participate in the programs. And in many cases, firms were selected on the basis of their credit quality. Okay, so credit ratings in particular. And in all cases, where there was no explicit restriction on the borrower quality, that could happen, but in those cases, the responsibility for screening was delegated to banks, particularly through the mechanism of partial government coverage that I come to. And this is the fourth, and actually this is the design feature that is perhaps closest to my heart, because this is the one that stands out in my study of France as the one that has really made a difference on banks' risk-taking. So but what do we mean by coverage? By coverage, we mean the percentage of the loan that is guaranteed, that is actually guaranteed by the government. Marco just mentioned that this is usually partial, okay? So here we plot it, okay? So the idea is that the higher percentages of government guarantee can reduce banks' skin in the game, okay? So and thus increase their risk taking. Here you can see that in half of the countries consulted that participated to the survey, the coverage depended could change, and usually depending on the size of the firm. Okay, so higher coverages were for smaller firms and vice versa. And in only 4 countries could coverage reach 100% of the loan amount, but full coverage was limited to just some special cases of very small enterprises or very small loans. Here I have in mind, for instance, Italy and Germany that have programs like this. So this is for the 4 common features that we highlight as mechanisms to reduce moral hazard on the bank side. Then we ask something else to the participants to the survey, and was an assessment of the characteristics of the firms and the banks that participated in the programs. Why is this the case? Because obviously the heterogeneity that Marco was talking about in the features of the various programs was reflected in the heterogeneity in the distribution of the loans themselves. And it can okay, so firstly, it can certainly be said, the 79% here, that in many cases the representation of the firms reflected the goals of the programs that we recall was mainly to support primarily small and medium-sized enterprises. Okay, so you see that the size of the firms that had guaranteed loans was smaller than average in almost all of the countries that participated with the survey. In terms of productivity and profitability, then the firms that received public guaranteed loans were in many countries indistinguishable from the others. And this is another quite interesting result that we find. And finally, in 5 out of 11 countries, firms that received guaranteed loans were on average riskier than the average. Okay, so this is not the majority, I know, and that's a good thing, but still, and this is a good thing, and this is a striking result actually. We will focus on it just in a few seconds, but just to know that still, even if it's just 5 out of 11, it's still 5 out of 11. And this can be problematic for financial stability because if these firms received their loans from riskier banks, this is what is called the bank risk-taking channel, obviously. Okay, so riskiness here, just to reply to a question that was made on the chat earlier, is measured differently across countries. Okay, so different countries use different metrics, such as the rating of the central bank, the probability the firms would default on their loans, and so supervisory things, the percentage of NPL. All of these of non-performing loans, all of this is measured pre-crisis, okay, ex ante, just to avoid issues. So to go on with this, so as I was mentioning, particularly problematic would be if risky firms receive guaranteed lending from risky banks. So let us look at the profiles of the banks that participated in these programs. And so first of all, you can notice that in most cases, these were larger banks. In no cases, they were smaller banks, okay? Moreover, In most countries, the banks that used guaranteed loans, so in the majority of them, the banks were no different from the average in terms of riskiness, in terms of capitalization, in terms of non-performing loan ratio, and in terms of liquidity. So this deserves a deeper insight. So because the issue of moral hazard is particularly complex, because banks have less incentive to assess borrower riskiness in the presence of guaranteed loans, okay? And this can result in excessive risk taking by banks, which in turn lend to riskier borrowers with the assurance of the risk that shifted to the public. But actually, our survey shows no evidence of extensive moral hazard in the respondent countries, as in ex-ante terms, borrowers and lenders are not necessarily riskier, and this is partly due to the program-specific features that we highlighted earlier. Of course, these results are subject to caveats. First, because our sample is not representative in terms of countries, okay? Responses were sent predominantly from advanced economies. This is something that we want to highlight. And this is potentially a bias, okay? Because implementing these measures requires significant fiscal capacity, both for the program themselves and to put in place early monitoring systems, obviously, okay? Second, and this is known by everyone working at the policy level on these issues, it is still difficult today to estimate business default rates of firms or on loans, because these loans have been replaced by other programs, oftentimes in supports to SMEs, firstly for the war in Ukraine and then inflation. So more than half of the loans at the time of the survey on 2023 were still outstanding. Okay, but still we have this finding that point out in the same direction that Marco said. Okay, so effectiveness that we are going to see in a few seconds, and in particular low bank risk taking and low moral hazard. So what we did was that we wanted to look at the literature on the topic, and what we went seeing were both the academic literature and the literature produced at the level of the policy institutions at the national level. And also from this perspective, we want to look at both the effectiveness side and the risk taken and moral hazard side. So from the perspective of effectiveness, the programs have generally been effective. So it depends obviously on the definition of effectiveness, because, okay, in the United States, for instance, firms that participated in the Main Street program would have, so they claim that they would not have received loans in the absence of the program. So in this sense, the program was effective. But as Linda mentioned earlier, there is a huge caveat, which is low participation due to the particular design of the program itself. In Italy, Schivardi and Romano find that without the program, firms would not have had liquidity problems. Then in Norway, Portugal, and in the UK, there is evidence that the loans actually went to the sectors affected by the crisis, which is another measure of effectiveness. So what about bank risk taking? And then I will come to an end. I do not manage to change the slide. Okay. From the perspective of bank risk taking, so the results that come out of the literature review are actually quite comforting, and once again quite unexpected. Because, okay, so this, you already witnessed the presentation of it, but okay, in France, Spain, Germany, and Italy, loans went, yes, to small firms, but solid ones. Norway actually gave less support to initially weak firms. In Portugal and Italy, and this is something that rapidly Linda mentioned earlier about the US, and Marco too at the end of his talk. So in Portugal and Italy, guaranteed loan programs were went mainly to more financially sound firms, okay, while the more vulnerable firms had more access to moratoria, okay, and this is another overall design element to consider. Because this is crucial in my personal opinion, but I think this is shared. Finally, in a paper that I wrote together with Theo Nicolai and Eric Vastenberge at the Banque de France, we find that weaker banks, so that in France, okay, it is the safest firms that have received the highest loans, the highest amounts of loans, even from the weak banks. And actually what we find is that the weaker banks have somewhat used the program to clean up their loan portfolio and to recapitalize themselves, as Marco said above. Okay. So to conclude, so it can be said initially that in terms of effectiveness, the programs have fulfilled the main function. Okay. As for the lessons that can be learned, I highlight here 3 of them, but then we have room for discussion. And firstly, let us take into account the important elements of the program design that mitigated the excessive risk taken by the banks. We isolated four categories, four principal elements: the restrictions on the firms that could borrow, on the allocation of funds, the caps on the amounts that could be borrowed, and the partial coverage of the loans. Secondly, another important lesson that we need to proactively invest in the framework and monitoring mechanisms before the crisis comes, so as to increase effectiveness and to reduce the fiscal cost. And the final lesson that I care about, both as a researcher and as a member of a policy institution, is that there is a high need for high quality data on banks, firms, credit relationships, lending itself, not only in the advanced economies, but all around the world, to study issues that are not yet understood and that can affect other economies or other macroeconomic contexts, even in advanced economies. So I'll end up here, and I thank you again for the opportunity.
Many thanks. Laura, you want to?
Yeah, so there are 2 questions that were online. Okay, partly where the first one was already answered by Stefano, was addressed to Marco, but it was answered partly by Stefano. Okay, and let me concentrate on first of all on the second one by Marco Butti. I think, Marco, could you see the questions? I think you can see the question because Giancarlo did write all the questions directly on the chat directly. Okay. So you read that directly and mainly to try to understand the difference between the different countries. So Germany and France, whether they were different with respect to Italy and Spain, mainly because Italy and Spain has less fiscal room in some way. And they decided to use more these, so the credit guarantees directly. Okay. So, and I also must say that I myself, I had to add a question there. So if I can, so may I also add mine? Or I don't know whether, Giancarlo, do you have more questions? So I will go ahead. So whether from the survey directly or whether the data from Marco, whether you see that you have new firms coming in, so firms that had never had any loans with the bank, okay, and they substitute trade credit, other sources of funding, trade credit with direct loan because it costs less, since they're mainly financing short-term working capital, okay? So do you see this kind of situations where firm never had a loans, they started to substitute trade credit with loans? And the other also, whether you have an idea along the supply chain, so giving more money or giving a lower interest rate credit, whether that has affected also the customer or these firms. So you have sufficient data that can also answer this kind of questions.
Okay, let me try. Regarding, there was a question in the chat, which was, to what extent can we learn from differences in these programs about, you know, the relative merits of this or that feature of the program? This is actually quite difficult, both because these programs were very similar, as a matter of fact. There were some differences, but they were mostly quite similar, but also because the shocks were widely different across countries. In particular, Italy and to some extent Spain were particularly hardly hit compared, say, to Germany. So it is difficult to understand whether the findings regarding, for instance, substitution that we have, which is that it is actually largest in Spain and to some extent in Italy, two lowest in France, and you know also in Germany relatively low. It is you know, to some extent a consequence of the design or a consequence of the shock, and also a consequence of the type of firms that were given the guarantees, because in Italy in particular and also in Spain there were a lot of really small firms with small loans that were given, and therefore particularly risky in terms of eligibility. They were given access to these loans. So it is quite difficult. Actually, the thing that actually surprised us the most, if I may say so, in the estimation is that when we break down the sample by country and we rerun these regressions by country, the results are surprisingly similar. So in terms of the way, for instance, risk, firm risk, the role that it played, in all countries, we find that actually there was a relatively more substitution for riskier firms. So also size had a similar effect, and so on and so forth. So the similarities are actually greater than the differences. Of course, to some extent, you know, say in Italy, for instance, there were more 100% covered loans. So this may have played a role in the fact that Italy had a relatively larger substitution. In terms of, there's one point that, you know, is on my mind that I would like to share with you. In a way, one key feature of these programs is the fraction of the loan that is covered by the guarantee. Now, if you raise it, and you know, in Europe, we did set a relatively high bar in terms of how you know, how much the bank should contribute to the guaranteed loan. So the amount we in a way we oblige banks to put some extra skin in the game when they were lending with guarantees. This actually may account for the fact that there has been quite substantial substitution, but at the same time has bought us less moral hazard and less risk-taking. So in a way, in Europe, probably we have chosen to be relatively strict in terms of you know, the risk coverage ratio, and this has increased the substitution, lowered the effectiveness of the program, but reduced the risk-taking. In terms of fiscal room, we don't have evidence on direct evidence on that, but actually there is this very nice paper by Lucas and Hong that I already mentioned, and they actually compare different countries. They also have data for the United States, for European countries, and for Japan. And what they find is that the countries that relied relatively less on direct fiscal traditional measures relied relatively more on guarantees. When you put the two together, the countries are surprisingly similar in their response. So in a way, what we did say in Italy, for instance, with the loan guarantee program, the US did with more, or Germany, for instance, did with relatively fiscal transfers. So in a way, the answer to what Marco Butti is asking is, it looks like that. Maybe more than from our study, from the study by Lucas and Hong. Finally, coming to the point that Laura raised, which is new firms. Indeed, we do observe that there are some new firms that are coming in, especially very small firms that were not previously borrowing, at least they were not previously borrowing more than 30,000, because 25,000. Remember, we don't observe the really small. So we see them surfacing when the loan guarantees are offered. The same is found by Bonaccorsi di Patti for Italian data. So it is a robust finding. Of course, there we cannot assess the extent of substitution because there was zero. We've observed zero lending before, so we don't know to what extent there has been a substitution because we don't know how much these firms were anyway borrowing from banks before.
Marco, we are really running out of time. I wonder whether,
sorry,
whether the
auto question. So
group of other authors would like to come in on it's a pity we don't have Spain in your study. It would have been nice to have also Spain. I don't know why he was not there in the.
We do have Spain. We do have Spain.
You do, but
yeah.
the report I haven't seen Spain, but I guess it's. So is there any? Would you like to? Because the lingering question about this is. Let me put it this other way: what kind of shocks could be addressed with these instruments? Clearly these instruments depend on the design, on the circumstance, many things. Is there something that makes it very special or something that may be brought in from a more structural approach, like when we think about climate change, innovation, any kind of very risky activity, is there any thought that you can share at the beginning, including Marco, if you want, of course? But I would like them to have a first take.
I'll also open it up if Jan or Sanalika would like to jump in.
Oh, yeah. Sanalika, Jay?
Eccola.
If I understood your question correctly, you're asking us about the role of any other shocks which could have affected how firms responded to the lending programs.
If these instruments are particularly suitable for certain shocks and not for others, how do you see the range of applicability? That is.
Okay, so I think while we haven't looked at that within the scope of the survey and our the research that we've done, but I would imagine that it all links to the repayment ability of firms, and I don't think it would be specific to the nature of the shock. So the repayment ability, whether it's the micro, small, and medium enterprises and how they get affected in terms of repaying the programs that are extended to them. So I don't think we find any linkages with the nature of the shock, but Stefano and Jean could add to it if they wish to.
We are really running out of time, so be very telegraphic.
Just to in 2 seconds, I agree with Sonalika. I don't think it's linked to the nature of the shock. What I think is that maybe it is linked to the fiscal room that Marco Butti was talking about. If you cannot mobilize direct lending and direct funding from the government, but you want to mobilize private, lending to firms, that can be in the toolkit.
Gianluca, probably I can say a few words about the nature of the shock. So my personal opinion is the COVID shock is rather like an aggregate shock, which is actually beyond the expectation of private sector, right? So it cannot be easily insured against. So then the type of public guarantee provides a mechanism which seems to me like a risk sharing between public and private, right? So this type of guarantee policy is seems to me quite suitable for this type of shock.
Yeah, I would agree. Let me add one thing. It was a shock whose effects were very easily observable because you could see the firms that were more affected because of physical distance and stuff like that. So you could identify the more affected firms, and the shock was not caused by a moral hazard in itself by the firm. Essentially, it was an aggregate shock. It was just mentioned, and it was, you know, given by nature, the pandemic. And
exogenous.
Yeah, it was largely exogenous and observable. So in a way, we were lucky because there was so to speak, because there was relatively less moral hazard than normally you would have in such circumstances. That is, if you try to use loan guarantees in other settings where the shock is less observable and less quote-unquote exogenous than it was in COVID, we may risk actually having considerably more moral hazard than we did at the time. So we should be cautious about, you know, saying, okay, the program worked well, so let's use it again and again. This may be, you know, problematic if indeed the nature of the shock is very different from COVID.
I agree.
Yeah, and just to add on that, you know, this was intended to be a severing of some of these amplification mechanisms, not intended to be a support program per se for banks. So you have to be very careful that, you know, you're just not subsidizing a risk that the bank normally would have taken by taking it off their balance sheets.
Right.
Jan, you wanted to say, because we are completely.
No. I think time is out. So I keep it for other conversations.
I guess it's fair to say that so far so good. We have now an interim assessment of this program. We'll see what happens in there, but all the indicators so far are not pointing to any dramatic consequences from the extension of these guarantees, although some of these guarantees are still out. And I think there is quite a bit of lessons to be learned. So like it is, we may see each other in the future, with a complete assessment. Thank you very much, Laura, Jan-Pieter, if you want to say anything.
No, thanks so much. It was great. We've learned a lot. I think everybody's learned a lot. Thank you.
Yeah, thank you very much from my side.
Thank you for the aficionados to this web seminar. We have another one next week on the self-financing deficit or self-defeating austerity, if you want. So thank you again. See you soon. Bye-bye.
Bye-bye.
Bye and thanks.
Thank you. Bye-bye.
Bye.
Bye.
Thank you.
Thank you.
Bye-bye.
Very well. Thank you, everybody.
Yeah, it was great. Thanks, Linda. It was great.
Long time no see you.
Thank you for having us.
I may see you at the IMF in November, if you are there.
Will you be there next week?
No, in early November.
Okay. All right, let's stay in touch. And Laura, good to see you.
Bye-bye.
Thanks so much. Bye, Linda. Bye-bye.